Now driven more and more people to stop making car payments. Stop paying, and that can lead to repossession.
And for the third quarter, the 60-day delinquency rate jumped up to 1.65%, well above a year ago, and easily the highest since at least 2010, according to TransUnion.
So Americans are struggling to make car payments at the highest rate since the Great Depression. Of course, we can remember that car repossessions tumbled in the early days of the pandemic, and the government sent millions of dollars of stimulus checks. However, they have increased as sky-high prices for used and new cars force consumers to take out much larger loans. In December, the percentage of subprime auto borrowers who were at least 60 days late on their car payments climbed to 5.67%. This is a vast difference from the 7-year low of 2.58% in April 2021. Hence, it's also the sharpest increase of Americans struggling to make their car payments since the 2008 financial crisis. We all saw prices of used and new cars surge last year due to the semiconductor shortage as well as other production-based disruptions in the global supply chain network. There were less cars being built while demand stayed very high, hence due to the supply-demand logic, car prices skyrocketed. Although, as you can see with this graph, the average price of a new car has subsided slightly, the average cost of a car is still close to $50,000. Rising interest rates and higher than average car prices have pushed monthly payments above $1,000. The percentage of consumers paying at least $1,000 a month for their new cars have increased to a record in the final 3 months of 2022. Even the average monthly payment has surged to an average of $728. This puts people in serious doubt whether they will be able to afford their car payments. Beginning of 2023, serious credit card delinquencies, usually defined as more than 30 to 90 days late, are expected to rise from 2.1% to 2.6%, the highest they've been since 2010. After becoming a pandemic success story, Carvana is at risk of going bankrupt. Rumours of bankruptcy and a potential restructuring have been swirling as losses mounted at the once thriving car company. At the end of the third quarter of 2022, the used car retailer recorded a 43% rise in total liabilities to $9.2 billion. This year, Carvana also expanded its network capacity and locations, which quickly became a costly proposition at a time when the return on investment was low. Last month, the auto dealer reportedly laid off 1,500 employees. It is estimated that the company has lost 98% of its value in the past couple of years. Americans are using more and more debt to fund new vehicles. Now, this shouldn't come as a shock. A simple reason why new car loans have hit record highs is simply because new car prices have also soared to all-time highs, as you can see with this chart. Industry analysts worry that the trend is only going to continue into 2023, with economists expecting unemployment to rise, inflation to remain stubbornly high, and household savings to dwindle. At the same time, a growing number of consumers are having to stretch their budgets to afford a vehicle. The average monthly payment for a new car is up 26% since 2019, and nearly 1 in 6 new car buyers are spending more than $1,000 a month on vehicles. So what exactly happens next? Well, as the economy continues to worsen in 2023 as a recession looms, the number of those falling behind on car payments will continue to rise. Even as consumers tend to give priority to their car payment ahead of most bills, because the importance of a car plays in getting to work or potentially providing the essential daily needs. For now, the rate of defaults and repossessions is expected to reach close to 2008 and 2009 levels, when there was a spike caused by the financial crisis. The percentage of auto loans that were 30 days delinquent was at 2.2% in the third quarter, compared with 2.35% delinquent over the same period in 2019. By contrast, just over 4% of auto loans went into default in 2009. However, that could quickly change once the 2023 economy unleashes the final whammy of mass layoffs, which we have already been seeing in the tech sector. We're expecting it to continue to increase and maybe even breach pre-pandemic levels because of the macroeconomics headwinds of higher interest rates, higher costs of borrowing, and expectations for unemployment to continue to increase, said Margaret Rowe, the lead auto analyst at Fitch. I think our expectation is that we're going to continue to see it go up, But it's just been so low that even going up isn't like what we saw in the Great Financial Crisis. Last year's new vehicle sales in the US were the worst in more than a decade. Industry estimates range from 13.7 million to 13.9 million new vehicles being sold last year in the US, roughly an 8% to 9% decline compared with 2021, and the lowest level since 2011, and sales were recovering from the Great Recession. Wholesale prices of used vehicles reached their lowest level in more than a month last month. As retail sales declined amid interest rate hikes, rising new vehicle availability and recessionary fears. As you can see with this graph, the peak may have been reached with the prices of used cars starting to come down now. We're seeing automakers slash prices. Just recently, Ford slashed its price on the electric Mustang in response to Tesla, which also cut prices by up to 20%. Used vehicle prices are expected to come down further this year amid rising interest rates and improved availability of new trucks and cars. However, they are still not enough to offset the 88% rise in index pricing from April 2020 to January 2022. Although car makers still don't have as many chips as they like, supply is bouncing back. New vehicle inventory was up 81% towards the end of 2022, with almost 740,000 more vehicles available than in 2021. Now it's just a matter of whether the person can actually afford it. Hence, although prices are coming down from its peak last year, high prices will stay stubbornly high. With interest rates expected to remain high this year, we can expect more delinquencies and trouble for the auto industry.